everyone, welcome to Fearfully Greedy. In today's video I will talk about Carvana. I have always deemed this business as uninvestable, but I will try to see, I don't know, if I can improve myself or something. Also, I'm a sucker for elegant models, so maybe that's something that happens here. First of all, remember, this is not financial advice. Please consult a professional or do your own research before investing. I also may hold positions in all these cost stocks. Take that into consideration. So Carvana thinks that the model they bring to the table is the one that has many benefits. So the first question should be like, what makes a better used car company? Like, what makes a better dealership? Customers care about three things. One is price, which will be tied to cost. So better cost will allow you to give better price. Assortment, which is how many cars can you sell to a single customer at once? Can you deliver at once? Which customer like because they want the car they want. And the third thing will be like perks, like buying experience, lack of purchase surprises, who has a better system for customer satisfaction. Let's see how Carvana does. First thing, I want to see the model. So a traditional dealership model will have a location, which will be like a showroom where there will be salespeople and a lot with cars. You go there, you buy a car. There might be like a finance department, a parts department, somewhere that you can have maybe some warranty and they fix your car for some years, that kind of stuff. But you will have a physical location which has all like the parts that you want. If you're gonna grow that business, what you have to do is get another dealership in another geographic location where you can serve more customers, but you kind of have the same parts in all the business. Does this lower the cost per car this way? I don't think so. There are not that many synergies of getting many dealerships. There might be a few, like better deals with banks, better deals of financing, better, easier acquisition, like in wholesale lots, other stuff, but there are not that many. Okay, so you have to many dealerships, which in turn they add almost the same cost per car. You just are a bigger but not a better business. Then Carvana comes in, and what they say, they have a better way of doing things. Instead of having all these prime locations, they will have a website where they buy and sell cars. They buy it from customers, but they also buy from wholesale. But they will have a website where they'll sell cars, and anything physical will be done in other locations, which customers don't have to go to. There will be storage lots, big storage lots, and then inspection and recondition centers where they will fix cars, but those locations will be specialized in that, so they kind of want to vertically integrate the system, so you don't have to have everything done distributed in all the locations where you sell your cars. And since you sell online, they just need to be close to the customers you want to get the cars to. And then it will be a hub-spoken system which lowers inventory, whatever, but you get the idea. Okay, then this will be cost, so lower cost might give better price. We still have to see. Also, website selling you the cars, it will say a price and you have to accept that price or not. So maybe it's more transparent, but if it's a better experience, I don't know yet. Then I wanted to see if they can display more of their inventory, like if they can have more of an assortment for you when you buy your car. And what we see here is that I picked a few locations in the US. And yes, Carvana displays more cars than CarMax. CarMax is the biggest dealership, publicly traded dealership in the United States. And they have arguably like double the inventory, so it seems like their system, Carvana system, can display more cars available for free shipping. So I filtered for free shipping. Visiting from Europe, I was getting blocked in this website, so maybe some of my data also is a bit dated. I did most of the analysis in April, so late March, April. So pardon me if some of this is a bit more dated. And then I did another one for price. So I took different most sold vehicles from 2021 2020, and I wanted to see what was the pricing. The pricing is pretty even. I compared it to Kelly Blue Book, blue book, where they kind of tell you what would be the market price for a vehicle. And then if you see Carvana tends to be lower price than CarMax, but not by much. What we see is more disparity in CarMax, like maybe since they have different dealerships who list their vehicles online, maybe they have different guidelines or requirements or goals for that specific moment. But price, as long as you don't make a profit, so anyone can sell cheaper price at a loss. So I don't think there's much signal in having lower priced cars here. And then for me, it's impossible to check customer experience. There are a few news, but they say Carvana is just selling cars who are stolen and all that kind of stuff. But I think the loudest voices sometimes is the one that can get a newsworthy message out. So I don't know. I took a look at Trustpilot and see what CarMax and Carvana were doing. You can see a much better score in Carvana. This at best is a very weak signal, so not much to check here. Then if we take a look at online, so there might be a premise: are we really moving online? Because if not, Carvana doesn't make a sense. So if we see in 2015 we had almost no cars sold in online, and now we are we got to 1.5% of sales in 2022, and now in the first quarter it seems to be trending down. Of course, Carvana has most of the share. If you see, it's almost everything. The rest is CarMax and maybe some Room, but those companies are going out, so it's almost 100% these two companies that can do this service fully online. And what we see is maybe some stallment, like they were stopping to go up, and then a bit of a retraction. I think that has more to do to Carvana pivoting into profitability instead of growth. But we could check, like, are we really seeing this 1.5% cap in online? And if we see the older cohorts for Carvana, so markets they have been operating for longer, we see much higher numbers than 1.5%. So the oldest one, 1.7, 2.5, 3.5, and these older cohorts, they keep growing at very high digits. So I don't think the market is saturated, let's say. Then I found a bit of a signal in one of the podcasts. I listened to many podcasts about Carvana and CarMax to see if I saw some signal. So we have one, the podcast is Enterprise Software Innovators, and CITO of CarMax, Shamim Muhammad, came to the podcast, and I found a few key messages. At 2 minutes 40 seconds, he says that we had to disrupt ourselves before somebody else did. We went all in, talking about going online. So I think when the number one dog in number one player in the market has to disrupt their model because someone else is coming for them, that has a strong signal to me. Like I like this. Then 5 minutes, he said that customers should decide what percentage of online or offline interaction and wants to do. Like they want an omni-channel. He says omni-channel is best. He says the most used online, but a lot still pick at the store, probably for cost reasons. But what I get from this second part is that sure, for the client is better because they can decide how they want to operate, how they want to buy from you. But I want to make an analogy, and pardon me if this doesn't make much sense, but let's say there's a front desk or front office and back office in a website. If your back office is not updated to this new version of vertically integrated and efficient kind of way of selling cars, then you're just cleaning and having a cosmetic front where you allow people to buy online doesn't make a lot of sense. Because maybe the experience is enhanced for the people that want to buy online, but there's not the cost benefits of that. Where Carvana's premise is that with the new model, there are these cost-cutting benefits. We'll see if that is also true next. But I liked this podcast, and the guy seems very bright, so I found some signal here to me. So, are there scale benefits? Let's see that. First, keep in mind that profits from this business there are three kind of profits, three kind of revenue generators, let's say. One would be the the retail, which is you buy cars, you sell them, there you sell them higher than you bought them, and there's the difference. And this includes cost of getting the car ready for the customer. Then we'll have wholesale, so you can do that also to professional clients, like people that want to buy and sell lots of cars, for them reselling to retail, or I don't know, but in big volumes, like wholesale. But this tends to be a much lower margin business. And then there's also other gross profit, which will be mainly finance. So selling that finance to the client, it's very lucrative. So if you see that most of the profit comes from financing these cars, that's always true. Like, it's not something Carvana is inventing. If you go to any like kind of dealership, you get like 15% loans or 12% loans for people that are subprime, or that they don't have the best credit score. If they keep paying, that's very lucrative. Of course, some of them won't pay, so, but still the difference makes it worth it. But just so you know, there are these three buckets of profit. Then I wanted to see if the new model brings extra profits per unit than the old model. Let's take a look first at CarMax. If we see units have moved since 2015 from like 600,000 to, in 2021 their best year was 900,000. So they had a 50% increase. Did gross profit per unit move? Not much, from 3,300 to maybe 3,500. So let's call it like that. So very small increase for how many units, so for how much bigger the business got. If we compare this to Carvana, of course we come from very small base, but we can see that gross profit per unit has moved from nothing to, let's say, 4,500 GPU. When units move from nothing, same, so maybe 100,000 in 2018 and 2,000 GPU, to 4,500 GPU when the units were 400,000. Okay, so we can see that as units move up in this model, those costs get distributed into more and more units. So I do see a benefit here in the model. If you don't see it, okay, I'm just saying what I see from the numbers I put in. Then I want to add all other costs, because GPU only includes the cost of getting the car ready, but in Carvana's case there's increased cost of getting the car to the customer, also IT cost and other costs, but getting it to the customer. This I took out depreciation and amortization, so it's not included, and also interest expense. So these are very extra bullshit earnings, okay, but pardon me. Okay, same happens here. If we see CarMax, as units move up, we can see that EBITDA per unit is flat. It's not going up that much. Where in Carvana, if we see units go up, as long as units go up, we see that EBITDA also goes up, close to positive EBITDA in 2021. So they have never had a positive year. So there's some signal here, but from current data, we cannot say that the new model can bring a profit, because we have never seen a profit in this business. So that's still in the future. So let's see if that really happens, where CarMax has been turning a profit every year since 2000. So lot credit due to CarMax also. Then let's take a look at, can they be profitable? So how would be the formula for them being profitable? If we take SG&A parameters per year, best ones, I took the best ones for every year, we get that the best they have done is $4,373. If we look at per quarter, so we take a look at all the quarters and try to find the best ones per unit, we can see that including the last quarter where the advertising was the lowest ever, it goes to $3,578 best SG&A per car that they have done. So anything above that for GPU is a profit. There's interest, there's other profit, there's other costs here, but positive EBITDA. So if we see, as units move up, in general the trend was going down in all costs per car. The moment that units slowed and we overbuilt and we have these huge systems, those costs get distributed into less units. So costs kind of spiked up. Okay. now we have done a pivot to profit. So if you see, costs are going down sharply, and we have in some parameters like advertising the lowest cost ever for Carvana. So yeah, I command this cost cutting, but can they be profitable? Yes, if they have higher GPU than SG&A, sure, they can be profitable. But we have to look at the elephant in the room, which is debt. They have a huge, huge amount of debt, which is pretty ridiculous, like if I say so. 6.5 billion. Woof. Interest expense is 159 million per quarter at this moment. And they are still losing money without taking into account this. So how can we make sense of this number? Is this even a question? Like, can they face the debt? What I did is I did a model. I did many modulations, but this one made as much sense as another one, and it shows a path to some profitability. What we get here is 3.5 billion of liquidity, with there's some unpledged real estate which they would have to sell to get to this liquidity, 75,000 units moving from this quarter, and 10% GPU. 10% growth in units and $5,000 GPU in Q2. After that, $4,300 in GPU. Can it be better? Sure. Can it be worse? Sure. This absolutely 100% it will be wrong in the future. I can guarantee that. But let's see what would turn what success would look like for Carvana. If they can move this cash flow as units go up, is at the moment that they pass 150,000 units that I see cash flow turning positive at current scale and current debt. So this includes debt, and this includes also maturities, so repaying debt. Keep in mind, in this year they have to repay 100 million of debt. In 2025 they have to repay 550. In 2027 they have to repay 600 million. So there's a lot of costs coming here. But the moment they move positive, and they can, in this scenario, they can face death. Okay, how realistic is this? Well, the current stock price shows that this is very unrealistic. But let's see. So I said under 150k per unit per quarter, they bleed money, a lot of money. Have they gotten close to that amount? They got to 117, but very profitable. So they need to get to that side and keep being as profitable as last quarter at least. Okay, yeah, I did the numbers in February or so. There was a 90% possibility of a bankruptcy at the time, taking the Olson O score. So the numbers are not looking great. So we need them to move units up, move costs down, and do that quickly. If not, bankruptcy is there, restructuring is there for sure. Okay, how is the outlook? Can this happen relatively soon? Okay, first thing that I want to look in the outlook is that the usual year for car sales is that in Q1 you have the spike in sales, that's the tax return season. Q2 and Q3 are more muted, like around half of that spike. But if we take the area, right, it's a bit lower than Q1. So there's a spike and then it's a bit lower. And then Q4 is the worst. Okay, that happens every year. Like if we take a look, that happens every year. Like there's always these seasons. What I also want to look, well, so from the previous, so from this graph, we can see that in first quarter we have some winds pushing us forward. In Q2 it should be like a slow wind the other way. Okay, so it's not the best time of the year, it's not the worst time of the year to be selling cars. Then in this graphic I want to talk about recessions. If we take a look at 2000 and 2008, 2009, and we take a look at the pandemic, we see that the volume of used car sales, it doesn't go to the floor. Like it's not half like the amount. It's muted when there's a recession, but it's a very important product. It's something very necessary for a lot of people to get to work. Without a car, most people cannot work. So it's kind of recession proof. Let's say something like that. I'm not looking forward to a recession, but it wouldn't be the end of the world. Like it's not like if a recession comes, it's the worst business here. There are business that do much worse in recession. Then this is from Cox Automotive. So if we take the seasonally adjusted and sales for used cars, we can see that we are a bit lower than a year ago. So they expect a bit lower sales in general than a year ago. Of course, this moves a lot, so I don't know. But bad data, bad point, a red point. Next is the affordability of cars. Cars are very expensive at the moment. If we compare to before the pandemic, we can see that the cars have moved down a lot. So there will be 200,000 new cars sold under 25k, and only 125,000 sold over 60k. And now it's the opposite. Like most cars are sold above 60k and very little are under 25k. So cars have become very, very expensive. If we take the used car value index by Cox Automotive and Manheim, we can see that cars have spiked a lot in price. So buy a car, the same car is much more expensive than before the pandemic. Then costs of financing has gotten much more expensive. So cost of that interest is going up and up. So not great. Also, so if we take a look at the monthly payment, this would be the monthly payment in January 2019. If we see the increase, most of it is price. So yes, cars are more expensive, but now it's creeping in the interest rate on those cars. This is the dealer track credit availability index, which just means like the accessibility for subprime borrowers to credit, which if we take a look, it's the lowest since April 2021. So that also is not great. Also, Carvana has a higher share of subprime, like so bad credit customers. So not great. Also red. Also bad thing. Customer sentiment is also not in the best point. Like, sure, it's lower than pre-pandemic. It's going up, but it's still much lower than pre-pandemic levels. So current customer sentiment, not great. Then this is from Deloitte, and it's like a purchase intent kind of index. If we see, we had a bit of a spike on the last months, but still is trending down. So people are not thinking that much about buying a new car. So like the fleet of cars in the market is getting older. So eventually they will have to change, because repairs and maintenance will go up. Those costs go up as those cars get older and older. So eventually they will have to change the cars. But for now, people are not thinking that much about buying cars. Then this higher inventory, so this like weaker demand for cars, has made that the inventories, their built up inventories for CarMax and Carvana, have aged longer. That adds cost to the business also. You have more cars than you need to. This is getting fixed. So this until January 23. This is getting fixed a bit for Carvana, probably for CarMax also. They are taking steps to lowering inventory. Then used vehicle retail supply. So supply, what can we get from supply? Supply is lower than 2022, so there are less cars available for sale than 2022, and we're selling a few more. So supply is tight. Okay, this is also from Cox Automotive. We can say the same. New days. So how many days available cars in days that they would be sold in. So if there were no more new cars available in 60 days, we would be out of cars. That's my reading. If I'm wrong, tell me. We can see that 2023 is the lowest unless 2022 for new cars. So supply for new cars is improving since last year. But if we take a look at used, it's worse than 2022. It's worse than any year ever in the last 5 years. So supply, not great. Because supply is a two-edged sword. Sure, there are less cars available, and if you have some of those, you have more price kind of thing. But there being less supply, it raises prices. It lowers the amount of assortment. So people that want to look for a specific car, it might not be there. So it lowers your sales really. Like if you have more assortment, more inventory, you sell more. Basically. So this is pushing back a bit. We have something happening, which I don't know maybe why. Well, I've read a few things why, but what is happening is that wholesale prices are going up where retail prices are going down. So maybe more cars are being pushed to wholesale to lower inventory. That's a bit what's happening. But retail price in general is going a bit down, but it's still very inflated. If we take a look at everything, if you would put like some light system, so season, we are in Q2, Q3, which are flat kind of seasons, not the best, not the worst, not great. Recession, I don't mean we want a recession, but if a recession came, used cars are still sold, so it's not the worst. Affordability is at the worst time ever. It's very expensive to finance your car. Cars are expensive, and access to financing is worse, right? Sentiment, if we take a look at the sentiment, is not at the worst point ever, and supply is tight. Okay, so not looking great in the light system. So what did I do? I bought Carvana. Sorry, guys. I want 250 shares. So it's not a big purchase, but yeah, I spent 2,000 euros in Carvana. And based on all this, I think it's an asymmetric bet. I think if Carvana wins, if Carvana survives, let's say, I think they make a killing in the market. Not to CarMax. I don't think it's killing CarMax. I think if we compare to all the mom and pop shops, as you would call, Carvana and CarMax have a much higher offering, and most of the market for used cars is scattered. So for me, I believe they have a chance of staying alive, of staying afloat, and I see good developments in getting there. And I think it's an asymmetric bet. At current price, let's say enterprise value is like 9 billion. They did 14 billion last year in sales. And let's say they could do like 10% margin when they have things dialed in. Yeah, it's expensive for how likely the bankruptcy is there. But if we take a look that once they survive, they might kill all like opposition. They will get a big share of the market, which I believe they can. This is not expensive. Like there's the 40 million used car market. So every year 40 million cars get sold. If they get 10% of that, if they get 20% of that, which I think it can happen, then the price doesn't make sense at current pricing. Okay, so that's a bit my bet. It's not a position that it goes down. I will keep adding because it's like if it goes down, it means that they are not doing the right thing. If it goes up, I will also let it grow. Okay, so that's a bit my thinking behind it. So the portfolio is sitting like this. At the moment, the position has appreciated, so it's 11% of the portfolio. It's 3.7k euros at the moment. Then we have PAX, Naked Wines, and Warrior Metcall. Is it a big position? Yeah, for most portfolio, but my portfolio, I like it very concentrated. Okay, and in 3 years, the portfolio has not appreciated a lot. Is this a loss? No, I have learned a lot. Also, I still think I need more years, and a lot of my positions, the theses are not broken yet, but they have not transpired. So I have sold in this time a lot of positions which have appreciated, and I think they weren't offering me that great returns. And a lot of my big bets are losing money, are down a lot, but I don't think the thesis is broken. So time will tell. I'm here for the long term, for decades. Let's see how it goes. I also wanted to comment in the first quarter results for Carvana. So what we saw was half the units from a year ago. Our revenue was 2.6 billion compared to 3.5 billion. But if you see the profitability initiatives taking at all, well, like showing up, you can see that they had a bigger profit selling half the cars, which great development. GPU, it's like in an historic like 4.3k. We have been here a few times. Finding receivables, we'll talk about this in a second. SG&A they expected to get to this point in the next quarter, so they say next quarter it should be flattish, but a huge reduction, and they need to keep reducing it per car. So either growing units or lowering this. That's what I would tell them, and they know. Adjusted EBITDA, it was almost flat. They think for next quarter they might have a positive EBITDA. But the receivables. So if you see, currently we have a huge amount of receivable held for sale compared to revenue. It's like 6 times the highest it's been. So in 2022 it was getting higher, but now it's 6 times the usual. Compared to revenue, it's 6 times. So they should get rid of some of them. In the earnings call, there was a question about it, and they say that they expect to sell as much as they produce of this product, but so far their markets have been a bit unstable, but they expect to release this amount. This should free like a few hundred, 100 million of liquidity for them. But yeah, just something I don't want to see this going up. That's all I will sell. All I will say for the next quarter. This is what we have to look in. What I will be checking for the next quarter. GPU over 5K. That's what they say. Units, they think it will be slightly lower than this quarter. SG&A in line. I would like to see this lower than this, but wishful thinking a bit. Adjusted EBITDA, they think they will have a positive adjusted EBITDA. That's the first step. Then we need positive, really positive economics, so really positive cash flow generation, cash generation, and then we can go back to growth, which is what I will take a look in. I hope I can bring you a new video soon, maybe talking about a bit of the other positions. I'm also taking currently a look at another company which I think I might pull the trigger. I will get into that probably sooner. I know I bought this stock 2 months ago, and I'm a bit late on the party, but I had a few projects going on. Well, thank you for watching. If you like this, please subscribe to the channel. It keeps me motivated to make more videos, and I hope to bring more videos soon. Okay, thank you, take care, bye bye.